There is a portfolio that has survived every major financial crisis of the last 75 years. The Great Depression aftermath, the 1970s stagflation, the dot-com crash, the 2008 collapse, and the 2020 pandemic. It was designed by Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world. And the vast majority of people who try to copy it get it fundamentally wrong. Not because the strategy is complicated. It isn't. It's actually one of the simplest portfolio frameworks ever designed. They get it wrong because they misunderstand the core idea behind it. And without that idea, the portfolio looks like a random collection of assets rather than the precisely engineered system it actually is. In the next 17 minutes, I'm going to walk you through what the all-weather portfolio actually is, why it works, the 2 mistakes most people make when building it, and what Dalio himself says about how to use it correctly. Section 3 is where most people's version of this portfolio breaks down, and fixing it is simpler than you'd expect. Stay with me. Ray Dalio founded Bridgewater Associates in his New York apartment in 1975. Today, Bridgewater manages roughly $160 billion in assets and is consistently ranked as the most successful hedge fund in history, not by a single year's returns, but by cumulative performance across decades and across every kind of market environment. Dalio's core obsession has always been the same question. How do you build a portfolio that performs, not just in bull markets, not just when everything is going well, but in every economic environment? Rising inflation, falling inflation, growth, recession, deflation, crisis. His answer was the all-weather portfolio. He designed it not as Bridgewater's primary fund, but as the portfolio he would give his family to manage his wealth after he was gone. A portfolio so robust that it would require no active management, no market timing, and no special knowledge to maintain. The logic behind it is what most people miss entirely. Here's the problem Dalio was solving. At any given time, the economy is in one of 4 possible environments: growth rising, growth falling, inflation rising, or inflation falling. Different asset classes perform well in different environments. Stocks love growth. Bonds love deflation. Gold loves inflation. Commodities love specific economic cycles. Most portfolios are accidentally optimized for just one of these environments, usually rising growth and low inflation, because that's what the last 40 years mostly looked like. When the environment changes, those portfolios suffer. Dalio's solution: hold assets that cover all 4 environments simultaneously, not equally, but in proportions calibrated to the risk each asset contributes to the whole. Here's what we're going to cover. Section 1 is the exact allocation, what goes in and how much. Section 3 is the mistake that breaks most people's version of this portfolio. Section 5 is what Dalio says about when this portfolio is and isn't appropriate for you. The all-weather portfolio has 5 components. 30% in stocks, specifically broad market index funds, not individual equities. This is the growth engine. It performs in rising economic growth environments. 40% in long-term U.S. Treasury bonds. This is the largest allocation, larger than stocks, and it's the one that surprises most people. Bonds perform in falling growth and falling inflation environments. They also provide a counterbalance to stocks. When stocks crash, long-term bonds typically rise. 15% in intermediate-term bonds. This provides additional stability and smooths the bond allocation across different duration risks. 7.5% in gold. Gold performs in rising inflation environments and in periods of economic uncertainty. It's the portfolio's inflation hedge. 7.5% in commodities. Commodities also perform in rising inflation, particularly in supply-driven inflation cycles. They add diversification that gold alone doesn't provide. Why this specific split? The percentages aren't arbitrary. They're calibrated to what Dalio calls risk parity, meaning each asset class contributes roughly equal risk to the overall portfolio, not equal capital. Stocks are far more volatile than bonds. So even though you hold 30% in stocks and 40% in bonds, in terms of risk contribution, they're roughly equal, because stocks move much more dramatically than bonds on a daily basis. This is the insight most people miss when they try to replicate this portfolio. They look at the percentages and think, 40% in bonds seems too conservative. But they're thinking in capital terms, not risk terms. In risk terms, this portfolio is far more balanced than it looks. Section 2 shows exactly how this allocation has performed historically, across the environments it was designed to handle. Backtested from 1984 to 2013, the period Tony Robbins highlighted in his book after interviewing Dalio, the all-weather portfolio returned an average of approximately 9.7% annually. In that same period, it had only 4 losing years. The worst single year was a loss of approximately 3.9%. By comparison, the S&P 500 had multiple years with losses exceeding 30%. In 2008, when the S&P 500 fell 38%, the all-weather portfolio lost approximately 3.9%. In 2002, when the S&P fell 22%, all-weather was down less than 2%. It is not designed to outperform in bull markets. In strong equity years, it typically underperforms a pure stock portfolio. It is designed to not catastrophically underperform in any environment, to be the portfolio that, 30 years later, has quietly compounded without ever causing a panic. The honest caveat: the period from 2010 to 2020 was challenging for this portfolio. Interest rates were near zero, which meant bonds provided little yield and had less room to appreciate. The bond-heavy allocation underperformed a pure equity portfolio significantly during this period. Dalio has acknowledged this. His argument is that over full economic cycles, including the downturns, the portfolio's consistency justifies the cost of underperformance in bull markets. Whether that trade-off is right for you depends entirely on your time horizon and your ability to tolerate drawdowns. And now, Section 3. The 2 mistakes that break most people's version of this portfolio. And the first one is almost universal. Mistake 1: using the wrong bond funds. The single most common error people make when building the all-weather portfolio is using intermediate-term bond funds for the entire bond allocation instead of the specific split Dalio prescribes. The portfolio calls for 40% in long-term treasury bonds, specifically long-duration instruments, typically 20 to 30-year maturities. Most retail investors either don't know this or feel uncomfortable with that duration and substitute shorter-term bonds instead. This matters enormously. Long-duration bonds are far more sensitive to interest rate changes than intermediate bonds. When growth falls and rates drop, long-term bonds can appreciate 20 to 30% in a single year, which is exactly when the stock portion of your portfolio is likely declining. That counterbalancing effect is the mechanical heart of how all-weather works. Use shorter bonds and you lose that counterbalance. The portfolio stops being all-weather and becomes something else. Something that has far less ability to hold up during equity crashes. Mistake 2: skipping rebalancing. The all-weather portfolio is not a set-and-forget strategy in the way most people understand that phrase. It requires annual rebalancing, returning each asset class to its target allocation after a year of divergent performance. Without rebalancing, the portfolio drifts. In a strong equity year, your 30% stock allocation might grow to 40% or 45%. Now you're no longer all-weather, you're overweight growth and underweight protection. Dalio is explicit about this. The portfolio's properties only hold if the allocations are maintained. Annual rebalancing, once a year, no more, is the minimum maintenance required for the strategy to function as designed. Most people who build all-weather never rebalance. They add to the fastest-growing asset and let it run. That's a different portfolio entirely. Section 4 covers the specific funds Dalio recommends for each allocation, the exact instruments that give you the exposure this portfolio requires. US-based investors. For the 30% equity allocation, VTI, the Vanguard Total Stock Market ETF. Broad exposure to the entire US equity market at near zero cost. For the 40% long-term Treasury allocation, TLT, the iShares 20-plus year Treasury Bond ETF. This gives you the long-duration bond exposure that is essential for the counterbalancing effect. For the 15% intermediate bond allocation, IEF, the iShares 7 to 10-year Treasury Bond ETF. This fills the medium duration component. For the 7.5% gold allocation, GLD or IAU, the SPDR Gold Shares or iShares Gold Trust. Physical gold exposure without storage costs. For the 7.5% commodity allocation, PDBC or DJP, broad commodity ETFs that cover energy, metals, and agriculture. Avoid single commodity ETFs here. Diversification within commodities matters. International investors. The same logic applies using local equivalents. For the equity portion, use a broad index ETF tracking your domestic market or a global index. For bonds, use long-duration government bond ETFs in your currency. Gold and commodity ETFs are widely available globally. The key principle remains the same regardless of geography. Long-duration bonds for the large bond allocation, annual rebalancing, and no substitution of shorter-term instruments for the long bond position. And finally, Section 5. What Dalio himself says about who this portfolio is actually for, and the situations where he says you should not use it. Who it is for. Dalio designed the all-weather portfolio for a specific investor profile. Someone with a long time horizon, ideally 15 to 30 years, who prioritizes consistency and capital preservation over maximum growth. It is ideal for investors who cannot tolerate large drawdowns, retirees, conservative investors, or anyone whose psychological response to a 30% portfolio loss would be to sell at the worst possible time. The all-weather portfolio's greatest practical advantage is that it makes panic selling far less likely, because the drawdowns are dramatically smaller than a pure equity portfolio. It is also appropriate as a set-the-foundation portfolio, a core holding that provides stability while you allocate a smaller portion of your capital to higher risk, higher return opportunities. Who it is not for. Dalio is clear that this is not the right portfolio for someone with a short time horizon or an aggressive growth objective. If you're in your 20s or early 30s with decades of compounding ahead of you, a pure equity portfolio will almost certainly outperform all weather over your investment lifetime, because you have the time to recover from crashes. He also cautions that in sustained low interest rate environments, the bond-heavy allocation will drag on returns. The 2010s were a challenging period for this reason. Investors who entered in 2012 expecting all-weather to outperform a simple index fund were disappointed. Not because the strategy failed, but because they misunderstood what it was designed to do. It is designed to survive any environment, not to dominate any single one. Let's bring it all together. The all-weather portfolio is built on one idea. No one can consistently predict which economic environment is coming next. So instead of positioning for the environment you expect, you build a portfolio that is genuinely prepared for all of them. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. Rebalance annually. Use long-duration bonds for the large bond allocation. Don't substitute shorter instruments. That's it. That's the entire strategy. The two mistakes most people make: using the wrong bond duration and skipping rebalancing. Fix those two things and you have what Dalio designed. Now, here's the honest truth about this portfolio that most videos won't tell you. The all-weather portfolio is not the highest returning portfolio available to you. In a prolonged bull market, a simple index fund will outperform it. That is not a flaw. That is a feature. It is designed to be the portfolio that, regardless of what happens in the economy, will still be standing and still growing when other portfolios have been devastated. Whether that trade-off is right for you depends on your time horizon, your goals, and most importantly, your psychology. If a 30% drawdown would cause you to sell, this portfolio may save your financial life. If you have 30 years and iron discipline, a simpler equity-heavy approach may serve you better. Dalio doesn't think anyone should use this portfolio blindly. He thinks you should understand why it works before you use it. And now you do. The next video in this series covers Peter Lynch, the man who ran the most successful mutual fund in history and built a completely different framework from either Buffett, Munger, or Dalio. One built for the individual investor, not the institution. That video is right here.